of few basic questions for 5 minutes, and then we take it on to a really high level. The reason I want to give you basic stuff, because so that you get aligned with the concept that we're going to talk about for 50 minutes now. There are some concepts that I will leave you with which you don't know. And why that is important? That is important so that you have a feeling that you need to know something else. If I tell you everything very easy, then probably you'll think that this I already knew and the session was of no use. But I want to leave you with some extra high concepts, some concepts, some complex concepts that you don't understand. But just to make your life easier, I am also going to talk in a layman's term, in a very, very common sense, so that all of you understand what I am talking about. So what are the different types of trade that we have? We have intraday versus a swing trade. What is an intraday? So if you can look at my screen, I have highlighted some of the stuff. If there is any problem, you can always stop me. Questions we will take at the end of the session, but if you're not able to see the screen, you can always. So you buy the same day and sell the same day. Market starts at 9:15 now, ends at 3:30. So you're buying and selling the same day, which is I have represented on my screen. So that is intraday. If there are days and weeks involved, then it is called swing trading or delivery position. It is also known as delivery position. Why it is called delivery? Because you deliver it into your account, you take it home. And if you are looking to buy at a low level and sell at a high level, that is called swing trading. Swing means what? When it goes up and down. So you try to capitalize on the opportunity that you buy at a low level and sell it. But the question is, how do we identify whether this is the real low and whether this is the real high, or is there a new high expected? So some questions we answer. There are other forms of trading also, which are known as intraday. We just spoke. Position trading is again something like I buy stocks and I hold it for a few weeks and months and days, and I get out of tomorrow. Something interesting feature that has recently come up in stock markets is buy today and sell tomorrow. Wow, that's very interesting. There are people who buy close to 3:30, between 3:15 and 3:30, because they think that tomorrow the stock prices will go up. Why do they think the stock prices will? They are expecting some news. There is a very important phenomenon in market. There's a very famous quote in the market: buy on rumor and sell on news. What is that example? The latest example was that Google is going to invest in Vodafone Idea. Every one of you, I think most of us have Vodafone Idea, others have Reliance, or maybe vice versa. Most of us have Reliance phones, and few of us have Idea Vodafone, which is a merged entity. So there was a news that Google is going to invest in it. You will see that the Vodafone and Idea prices just shot up. So it was buying on the rumor and selling on the news. And when the people saw that there was no such thing which was in existence, and the board of both Idea Fund said that it is not true, they exited. So there are people who buy today and sell tomorrow. That facility is also available. So you don't have to hold it forever. If you have not sold it, you can sell it tomorrow also. Your respective brokers like ICICI Securities, HDFC Securities can train more on that. That is not the purview of our session, but these are the various features that we have in our account. Okay. Now this is how a screen looks like. If you open a trading terminal, or if you open your stock account with the apps or the software that you have, this is how it looks. So what you're seeing right now is Nifty 50. You have all these stocks listed here. There are symbols there, there are trading symbols. Whether there is a buy or sell, you can click on buy and you can click on sell. There are bid quantity and bid prices, so various quantity at which these stocks are being sold. The most important is the last column that I want to bring your attention to. It is the last traded price. So that is the price at which you can buy one Asian Paint stock, or this is the price. If you look at the second row, you can buy Britannia stocks. What are the various prices? Asian Paint is, for example, whenever I took this screenshot I've taken today, this is a Friday closing 3:30, 1686 rupees. Okay, so good question. If these are stocks, is the financial market so easy that we can buy only stocks or underlying, as we call it? No, financial markets is a very innovative world, and that is why we say that we are learning every day. So what are the other products that we can buy? Okay, so let's go to the next screen and understand what you can. But I hope you have understood the concept of LTP. Most of us already know it. This is a sort of a refresher session for another 5-10 minutes before we get into some interesting stuff. So you have LTP and the quantity. So at whatever quantity I am punching as a trader, as a portfolio manager, that is shown in the bid quantity. All right. So as I said, the financial world is not so simple. There are products built onto stocks. So products built onto products, like you have Uber and Ola model, that the vehicle is owned by someone, then there is a driver, he's a third person, the vehicle is owned by someone else, the customer is someone else, and there is an app through which you can book. So it's a product over product concept, as you call it. Someone owns the product one, someone owns the product two, you put it together and becomes a third product. So similarly, the financial market is very, very innovative. We have derivatives as a product, wherein the prices of the derivatives are arrived from stock prices or underlying. So let me go back to my screen one more time. uh, Asian Paints and Britannia are stocks. So we can have derivatives based on Asian Paints and uh, the other was Britannia. All right. So you can have a forward contract or you can have a futures contract. In stock exchanges, we can have only futures contract. You have options and swaps. In for this session, we are only going to talk about uh, you know options. I'll show you. I'm not going to give you theoretical knowledge, but I'm just going to show you how you can make uh, use of it. All right. So you can buy a call option or you can sell a put option. So these are the two derivatives that we're talking about. What is a derivative again? The derivative is something which derives its price from the underlying. What is the underlying? I will again take you back to the screen. The underlying is Asian Paint and Britannia and these stocks. All right. So likewise, you can have derivatives based on this one. I think someone has been very creative in using the annotation. I will annotation tool knowingly unknowingly. Please, I will request not to touch the button because it keeps popping out. All right. So once you have understand what are derivatives, we are going to talk about buy, call, and sell. Call option and the sell option. These are the only two things we are going to talk about. What are those products? We will talk about later in the session. But let us proceed. Okay. So the first question, as a fundamental research analyst, or as a portfolio manager, or as a trader, or even with a person with a common sense, first question is, how do I choose my stocks? That is the important question. So first thing that you do is a fundamental analysis. What is a fundamental analysis? Fundamental analysis is something wherein you are looking at the right economy, the right industry, the right company, and whether the company has a future or not. So that's a part of fundamental analysis. So I have put point 1, 2, 3, 4. You can just go in that anti-clockwise direction. I'm looking at the economic conditions. So what do you think is the economic condition right now? All of us know that we are suffering from this very severe phenomena called COVID, and the economy across the globe is has taken a hit. All the economies are battered, have been beaten down badly. India is also has faced similar situation. So, which is the industry that we can choose in this situation? The best part about stock market is that you can always choose stocks, whether the economy is going up, whether the economy is going down, whether the stock is going up, or economy is going down. You can always make money out of it. That is very important line that I'm making, and that is what the financial market offers you. Yeah, if you are doing with the commodity, it is always not possible to make money if the prices are going down. You see these farmers losing lakhs and crores of money when your tomato or onion prices go down. They don't have a mechanism. But in financial market, you can always make money whether the prices are going up or down. But that doesn't mean that you always make money. You have to be careful. Second part is industry analysis. So let us think for COVID, which is the industry that you would want to have. I will show you in the next presentation, in the next slide. Then once we have finalized the industry, which is the company I can choose. All right. So let's go to the next slide and let's see what is in store for us. Meanwhile, again, I will clear the annotation. Someone has been using it. Anyways, no problem. That's the challenge with technology, but that's always welcome. All right, so let's talk about very quickly fundamental analysis. You see all these economies here. This is from IMF that I've pulled out. You see the economies which are in green and red zone. This was updated March 2020. This is done by IMF. India we see in green zone, but I understand that India also will become a red zone from economy perspective, right? So the economy is not really doing good, and India also, I think, in FY21 will become a red zone. So if economies are not performing, then which stock or which industry do I choose as a first example? All right. So let us look at the things that we can choose. And so I can go for defensive stocks. What are defensive stocks? Wow, that's an interesting concept. As I said, I will talk in a common man language or a layman's language, but I'll ask you some interesting questions. What is a defensive stock? FMCG or food or pharma that you never stop consuming, even if the economy is going down. That's called defensive stock. And these stocks have given money in the last 2 3 months. This has given a lot of money in the last 2 3 months. So if you're aware that you will still keep consuming Ashirwad, Ashirwad atta or Ashirwad rice, or you would buy Maggie products or Nestle products or Hindustan Unilever products, or you would buy sanitizers, you would buy medicines, then you would have focused on these stocks. So once we understand, okay, this sector which is performing now, and I will prove that. I am not just saying because I'm saying that, I will also prove it in my next slide that these stocks are performing, this industry is performing. And what is the reason for that? You see that on the left thing, I have put the photograph of a or a animated thing of a coronavirus. It's a very dreaded thing. So let's go to our next slide. Yeah. Okay, so this is a screenshot from an Edelweiss software which is available free of cost. I am not advocating any stocks or any industry. This is just for educational purpose. Let me clarify. But I have just plotted year-to-date performance. You see, there are FTD, WTD, MTD, year-to-date. So I've just said from year-to-date what is the performance of various stocks in the Indian stock market, and that is specifically Nifty Stock Exchange. Do you know an interesting phenomenon about Nifty? Nifty, which is NSE has the largest derivative contracts being traded in the world, not only just India, but in the world. It has crossed the US market in terms of the number of contracts traded in the world. Now we talk about India being powerful, India, not buying Chinese goods, India being, raising its own capital, having its own companies. It is only possible once these smaller companies, which are good companies, list on the stock exchange. So you will have to come to the stock exchange if you want to make India powerful. Otherwise, you'll be missing one important part of the story if you're not a part of the stock exchange. And we will have to make our stock markets very, very market, so that anyone who has a new idea can raise funds from these places, from investors and from stock market. All right. So let's come to Nifty Pharma. You see this is a 26% return that you're getting. And I just clicked on the Nifty Pharma, and if you see on the right hand side, you have these stocks which are some of the top stocks in the Nifty Pharma. You have Aurobindo Pharma, you have Cadillac, you have Dr. Reddy's, you have Biocon, and this is the year to date returns that they have given. Year to date returns meaning starting January till date, till whatever was the last date, which was Friday, the last Friday. Aurobindo Pharma has already given me 70% returns. But how could I have noticed it? This I am noticing once I am showing you or someone else has shown on the screen, but 70% is already gone. I have missed the story. Next question appears, oh, if I have missed the boat, is there some opportunity still left? Can I still buy some stocks there? All right, let us see. So these are some of the top performing stocks in the Nifty Pharma sector. And I just said, okay, which are the sectors are performing? So I need to keep a track on the sectors that are performing. I'll have to filter that. And there are softwares to do that. When I come to your college, probably we'll discuss this in detail. All right, then I go to another website. These are all freely available data. There's a site called Markets Mojo. And I am saying, okay, then how do I choose a good stock? Whether I should have quality management, whether I should look at valuation, whether I should look at financial trend. In short, I am telling you, just focus on three different important concepts, just three important concepts. What are those important concepts? Look at the quality of the people that are associated with that company. What is their education background? What is their sectoral experience? What is their domain experience? How many years have they worked? What is the management quality? Have they done any fraud scandals? Should I buy Kingfisher, Vijay Mallya stock? Should I go for Diwan Housing Finance Limited? Should I go for Yes Bank? I flagged Yes Bank about 4 years ago that some now the problems are being sorted out. The management, they have changed at Yes Bank. It doesn't mean that Yes Bank is a good bank or a bad bank that I'm suggesting, but I'm just saying that 4 years ago I had told people that there is some problem happening in the Yes Bank with the management. So it should be flagged. Flagged means you should be aware about it. So management quality is one. Then we look at valuation ratios. What are valuation ratios? Some of you have understood. In a layman's term, if I go to the market and if I see that a price, say a flat, in the real estate market, one flat is selling for 1 crore. In the same locality, the other flat is selling for 1.5 crore. In the same locality, the other flat is selling for 3 crores. Which flat would you buy if all things are constant? If the things are constant, if the society is good, the management is good, people are good, then I would go for a cheaper, flat which is 1 crores. If the management and the society of the flat which is of 1 crore is not good, I would skip that and I would choose between 1.5 crore flat and the 3 crores. Likewise, in a stock, you would look at what is the valuation. Is it a cheap valuation? Is it an expensive valuation? And by valuation, I simply mean here price to earnings ratio. Anyone can go on the Google, you can take a screenshot of this one. You just have to look at price to earnings ratio, because I need to understand in the same segment, in the same industry, which is the stock which still offers me a space. Meaning what? If Aurobindo Pharma has already given 70% in terms of the price, it has already moved up, it has already run up, why would I buy Aurobindo Pharma? So I am right now, if I'm talking today, I'm looking at a fair valuation of the stocks. So I would look at, right now I will just talk about one thing. In the valuation, there are various ratios. Focus on price to equity ratios, or price to earnings ratio as we call it. Then what? Financial trend. Oh, this is very, very important, because all your stock manipulation, price manipulation, or your volatility or your changes come around uh, the result calendar. When the results are being released, the results are released every quarter, so you have to be careful about that. Now let us talk about quickly. So management profile, so ranges between average and good. On this slide, I have chosen Alchem because it is good right now. There are three good Biocon, Aurobindo Pharma, Torrent, and Alchem. These are all good. Above, I will be just average, I would not choose. Valuation ratios, if I'm looking at, so I would look at something which is still attractive. Now then I need to investigate further. If it is attractive, is it a bad stock? Because price to earning ratio, the price is in the numerator. If the price is low, is it because there is something wrong happening with the stock, or there is something issue with the stock? So I need to investigate that. But for the time being, if I am given this chart, I'll go for an attractive valuation. I will not go for very expensive, like Biocon is very expensive, Torrent is already very expensive. Aurobindo Pharma is still, they're saying that it is fair in comparison to others, but will I go and choose that stock? Then comes the financial trend. It ranges on this slide, it ranges between flat, negative, and positive. Negative is a clear no. I would not choose a stock which has given negative results in the last quarter, in the last 6 months, last 1 year. I would not choose that stock. I will remain away from that. There are people who choose that, but those are restructuring guys. Those are different kind of specialists. All right. So I am choosing for a PNL which has given positive. And so 1 plus 2 plus 3. Right now, I am choosing Alchem Laboratories from this stock, but I need to investigate further. Just one slide and one research is not sufficient. It's a very tedious task of choosing the right stocks. But from this slide, if I were given a choice, I would say, okay, Alchem Laboratories, I will investigate further. Management is good, valuation ratios look fair, look attractive rather, and the profit and loss, there is no loss in the profit and loss. Let us see, if I would have chosen Alchem Laboratories a couple of weeks ago, what would have happened? All right. So Aurobindo Pharma, and why is Aurobindo Pharma expensive stock now? Why is it given 70% return in the last 6 months or so? So I will take your attention to these highlighted ones. If you can look at the June 8 Aurobindo Pharma table 1. So I have, for your easiness, for seeing it, for making it easy for you, I have three tables for you, 1, 2, 3. So Aurobindo Pharma is table 1. June 8, you can look at. The EPS actual was 14.5, and I have highlighted in yellow. They were forecasting, the analysts were thinking that the earning per share, how much earnings one share would make of Aurobindo Pharma. So it was 14 rupees, and the market was thinking that it will make 11 rupees and 15 paisa only. So they made 3 rupees and 35 paisa more than the market was expected. And what happened? We'll see in the next slide. Okay, let's come to Alchem, which is table number 2. You go to June 8 on the row, and you see what happened. It made 15.79 rupees per share. When was the result declared? Same date as June 8. What was the market expecting? Just the next column, which is 1805. You see a negative 0.2 minus 2.26. 2.26 So Aurobindo Pharma gave a positive earnings of a surprise, as we call it, plus 3.35. I was expecting a performance of 100, you gave me 105. I was expecting a performance of 200, you gave me a performance of 300. It is like your math score. The parents always expect that the student will, or the child will get better score. They are expecting 100, but you got only 50 max. So this is a surprise for them. It was no surprise for you because you already knew it. So if you have not performed good in the exam, the stock prices will go down. If you have performed good in the exam and performed better, the stock prices will jump up. Let me bring your attention to table 3, which is the earnings calendar. This you can download from NSE or BSE. This is also called results calendar. For example, 28th of June, these are the companies. Some of these, Nilkamal is one which makes furnitures, which makes furniture. And then you can see what results it has given, whether it has given a good result or a bad result. So I have sort of given a screenshot of it. So I understand that this is a very important earnings calendar is a very, very important phenomena, and you should be very careful when buying stocks near the earnings calendar, meaning when the result it will be. So if you are buying something around 29th of June for the Nilkamal, you got to be careful. All right. So what has happened in the five? These are, let's look to the table to the right. You will see that the prices, there are prices of Aurobindo Pharma that I have mapped of 5 days, 20 days, 50 days, 100 days, and 200 days. Uh, the prices, you will see that the last 200 days was 537, whereas the last 5 days it was 790. Last 20 days the prices were 7. So you'll see that there is an increasing trend. The stock prices have always moved up. Why has that happened? It is related to the earnings calendar, because Aurobindo Pharma surprised everyone, and everyone is very happy with this performing horse, the winning horse. You want to bet on a horse which is performing, which is winning the race. You don't want to bet on a stock which is losing the race. And let us go to the next slide and see what happened. All right. So I have just put a comparative chart here. This is from investing.com. The one that you see in the red and green is the Alchem, and I compared in the magenta color, which is Aurobindo. See what happened. They declare result at the same time. The Aurobindo Pharma, where it shoots up, and what happens to the Alchem. Now, when Alchem says that its price is, the valuation is fair, it is where because the stock prices have fallen down. Now, some analysts will again find reasons to invest in Alchem. But I would investigate further whether I should go into Alchem or not, because it did not perform as the market was performing. Yes, if I'm expecting some future news, then I may invest in Alchem. So I will investigate further. Also, please remember, this is a very important statement that I'm going to make you students and all my participants here. And I believe there are about 400 participants which are online on various platforms, Zoom and YouTube, that stock prices do not reflect, if I am trading right now, stock prices do not reflect my prices now. They are reflecting it. If there is some news which is announced, it is absorbed in 20-30 minutes. Stock prices reflect expectations in the market. What is going to happen in another next day, 3 months from now, 6 months from now, 1 year from now? So will Aurobindo, is it doing better research for finding COVID solution? Maybe yes. Maybe Cipla does it better. So if some that they people think that Cipla will have a better result, a better drug and a better pharma solution for COVID, the stock price of Cipla will jump up. So stock prices that you see here are not present day stock prices. It has an expectation built into it, and that is why they call it EPS surprise or EPS forecasted. So the stock analyst or the analysts are sitting on the earnings. They have already developed their profit and loss and balance sheet, and they are sitting on it. It is a forecasted tool, and once the company releases it, they will match. Okay, this is what I thought, and this is what the company has released. If the company has done better than that, then the stock prices should go, and people will stop buying. And this is what has happened in Aurobindo Pharma. Let us go to, so this is the impact of the financial trend. Earnings calendar, as I said, is a very, very important phenomena. So you need to watch out for it for the sectors that you're interested in. Now, since we have less time, let us go to technical analysis. So one quick snapshot for fundamental analysis: management profile, valuation ratios, specifically price to earnings ratio, which most of here, especially the MBA students. Price to earning tells you how expensive the stock is, because in the numerator you have got price as the variable factor, and then the financial statements. Let us go to technical analysis now and see some. So Swati ma'am, at the opening of the session, did mention about volatility. What is volatility for a common man or for a student of statistics? It is nothing but a standard deviation. So let me give you a very common example. If, for example, if you go and buy potatoes in the market, and if the uh, potato sells for, say, 50 rupees on one day, 40 rupees the other day, then it sells for, say, 20 rupees the one day and 10 rupees one day, and the average price, say, let us assume, is, say, 25 bucks. So the zero that you're seeing here on the screen is the mean, basically, so is the standard deviation. So my, if the average price of the potatoes is 25, and if the stock the potato prices fluctuate between 10 rupees and 50 rupees, so that is the range it covers. And if the stock, if the potato prices are too volatile, then you would not buy it. Likewise, in a stock market also, if the volatility one that the volatility is good for the market, because if you buy something, for example, if you buy flat, and the stock prices, the flat prices, even after 5 years is at 1 crore. Say you bought flat at 1 cr, and you are expecting the prices will go up, but it doesn't move. And even after 5 years, the flat price is only is at 1 cr. Then there is no volatility in the market, and you in the residential market, and you have lost it. Likewise, if you buy some stock at 100, you want the stock prices to go up, and that is only possible with volatility. So volatility is good for markets. That causes both up and down. So as example, I told you, if the average price of potato is 25, it can go to 10 also, and it can go up to 50 also. So volatility is good, but it happens both sides, up and down. But extreme volatility is bad for the markets. And if there is extreme volatility, most of the statistics students would have studied skewness, and that is what we represent. Let us talk in more common terms. Okay, this is a matter of statistics. Some of us may get confused with this kind of a complicated graph. So let us go to our standard. Let us go to our next slide and see what's there. So if I am a trader or a portfolio manager or a student, how do I measure volatility in the market? So one thing that you have to go and search for is a VIX. VIX is an index which is developed by National Stock Exchange, NSE, in association with the Chicago Board of Options Exchange. So on 23rd March, you'll see when the markets crashed, the VIX was at the highest. So VIX runs in has a negative correlation with your stock exchanges, with your index. So VIX is getting too high, it is the time to get out of the market. So maybe you can note it down that you can measure volatility as a student of finance. You can measure volatility by looking at VIX. It is a publicly available data. If the VIX is too high, and how do you measure too high? Above the average. So if you look to the left, if you look at these pointers, and let me use the annotation here. Just 1 second. Just give me a moment, friends. Yeah. So if you look at these one, these are the averages that you have got. If it is running high above the average, you got to be careful. Now you'll say that I am not a trader. Why should I be using VIX? Okay, you could be invested as a long-term investor. You could be a portfolio manager. You could have your own mutual funds invested in it, or you could have money in the market, or maybe you are planning to invest, buy something or invest something. If the VIX is too high, even in your local market, you would not go and make the investment, because if the stock market is crashing, maybe that is a bad sign for the economy. So if you are going to buy and open a shop, a new shop, if you are going to take on rent, if you're going to buy a new flat, maybe you will not do that. So VIX is a very, very important tool. Let us move to our next slide. So I hope you have understood VIX as an important tool. What is the first thing that you would, okay, I understand volatility, but then what should I do with it? So what is the first thing that you would do in the market? Open your computer and see how the markets has performed globally. National Stock Exchange, sort of most of the time copies what is happening in the global market, especially in the US market the day prior. So open your your stock brokerage account or your online this thing. You can find this on Money Control, investing.com. Look at what markets have performed. If the stock markets have fallen the previous day, the previous night, say in the US the markets have gone down and the Canada has gone down, then you need to be careful while trading. So you have to look at what's happening in the global market the previous night. The European market opens about 2:30, so that is when we experience a lot of volatility in our market, because these guys who are sitting in Europe start buying in the Indian market around 2:30. So these are some of the points you need to be careful with your investment. All right. Okay, so I've looked at the volatility. I've seen that okay, maybe the market opened at the US market closed on a positive note. Then what should I do? Okay, so go to National Stock Exchange website and figure out where are the top 10 gainers and losers, because as I said, you would want to bet on a winning horse. So you want to look at who are the top 10 gainers. But if you have a different strategy, you may also look at which are the top losers, because if those top losers are there, maybe they have an opportunity to come back again. So I open this from the National Stock Exchange website, and I see Nifty 50 and Nifty Next City. In short, you are only looking at top 100 stocks. We are not going beyond top 100 stocks, no matter what, because that is the area where you start making losses when you buy cheap stocks of 5 rupees, 10 rupees, 7. Those are purely speculative stocks in most of the cases. So let's just focus only on 100 stocks. How do you know these are top 100 stocks? You can look at this one, Nifty 50 and Nifty Next 50. We are looking at gainers right now. So as a first step, let's not look at the losers, let us look at the gainers. And these are some of the gainers that you have. Then you want to investigate further why they are gaining. Is there something, some good news, some good financial result? Then you may want to take a call for how many days you want to invest. You want to invest and get out in a week's time? Do you want to invest and hold it for a long term? If the price is already too high, will you wait for these gainers to come down to the losers list? When they come down losers and you think everything is going okay and the market's stock prices have just corrected like that, then you will wait for the gainers to come to the losers list and buy from there. All right. So if the stock has already run up too high, then you would provide some time for the stocks to cool down, because you would not buy a stock which is very hot, which has already run up too much. So these are some of the tools that you will use for deciding the which stocks to get into. So we are filtering which stocks to get into. All right, so let me give you some example on the next slide. All right, so there is, so once we have figured out, okay, these are the say gainers today, then how do I choose? Should I buy all of those? Should I buy one of those? Which stock should I buy? So there is another very interesting data which is available free of cost on National Stock Exchange, which is called daily volatility. So you would go and buy stocks which have good volatility. And what is that volatility? The volatility should be above 2.3. This is all calculated in this sheet that you can download from the stock exchange. So I would not choose for a stock which has a volatility of less than 2.3. So just to, because all of you have a Facebook account and all of you use Facebook, I have purposely pulled out Reliance here, which has a volatility of 2.83. Maybe it was not in my list of the gainers and losers, but maybe I'm interested. The day Reliance has already cooled off after running a hot, maybe it appears in the losers list because it has already run up quite a bit and then it is now cooling off. But the volatility in Reliance remains above than 2.3, which I have highlighted here in this table, if you can look at. So you should focus on the daily volatility and then make a decision. You would not buy a stock which does not have volatility. Otherwise, you will not make money out of it. Okay. So I have figured out my top 10 gainers and losers. Then I would go to the NSE and download the daily volatility. If from the top 10 gainers, and say let us consider only the gainers right now, if the daily volatility is high and it appears in the greater than 2.3, then I would filter those stocks and start looking for a correct entry point. And that is the most important, because you have already learned fundamental analysis in your MBA school, but we still not have learned what is the entry point. So I am choosing the entry points now. So I am teaching you ways, giving you tools how to enter into a stock market. Is that stock market so simple that you just look at the volatility filter, the top 10 gainers and losers, and decide, okay, this is the stock that I want to? If the markets were so simple, then everyone would have made money, but only few people make money because no one takes time to get into these parameters and tools. So what is the idea of doing all this? We are creating a stock warehouse, warehouse where you store these stocks. So I am building a list of stocks that I want to get into, and I will wait for the right opportunity. Now, how do we identify the right opportunity? That again we will see. So let us go to the next slide. I'm sure you're enjoying it already till this point now. So let me just change the slide. Okay, wow. So the quiz to you is how to identify the entry points. I see this graph now. Let me just quickly give you what is this one. So this is the Reliance Industries. This is a 5-minute time frame. So you'll see that every calendar, and let me use the annotation tool for you. So every calendar here that you see, every candle that you see is a 1 minute, is a 5-minute candle. So one green candle is of 5 minutes. So it was formed in a 5-minute time frame. If it is a green candle, that means that it closed at high. It started here, and then it closed here. Okay. What does a red candle mean? Red candle means that it started here and it went down. So that is what is a green and a red candle. All right. So the question again I ask you, is the technical analysis only for intraday traders? No. Even a long-term investor, even if you're investing stocks like Warren Buffett for 50 years, you will wait for the right opportunity. If you're not waiting for the right opportunity, then what happens? You lose money. So even Warren Buffett waits for the right entry point. He doesn't go and buy any stock at any point. Once he has built a warehouse of the stocks, he will look at what is the right entry point. Should I enter here? Should I enter here? Could I have entered here? But who will tell me at what point to enter? So that's an important question. So let us go to our next slide and see how we can decide. So I will give you a couple of tools and couple of strategies to decide how to decide which point to enter into. All right. So strategy 1.A. Now we are coming to the most important aspect of the presentation, that how do I decide that when to enter. Remember that the one, let me just use the annotation tool, and this is a volume bar that you see here. All the data that you see here as red and green, I hope it is visible to you. These are volume candles. And what are these? This is price for P and volume for V. So I have said that volume is a precursor to pricing. What does that mean? Oh, something interesting. That means when you see that there is very high volume happening here, something is happening in the stock market. And see, this happened much prior to when the prices started rising. The volume came in, the huge volume came in much earlier than the rise in the stock prices. This is the area when the stock prices. So if I'm keeping an eye on the volume, something is happening, and you see that the stock prices have already fallen down. That is why I said, that losers also make money once you know what is the correct entry point. So this market has already corrected, and I see a lot of huge volume happening. I see then the stock price is rising. So if I know that there is a huge volume happening, and prior to that stock markets have already corrected, or the stock price is already corrected, maybe this is an interesting point. See this, I will clear again, and stock prices rise, then it comes down. It goes like a ball on a steps. Stock prices never go up in one direction. It always goes up, down, up, down, up, down. So you have to know the correct entry. Goes up. All right. So I will probably enter here and get out here, because I have made by return percentage. So one important concept is you have to know what percentage you are making on your stock. Okay. Say I missed this opportunity. Let me clear this tool again. And I say I missed this one opportunity. This one is gone. Then I keep looking at the chart. Maybe a little later, a few days later, I see there is huge volume happening here. Okay. Is there something happening? Maybe I noticed one. And the graph that you see here, a smooth graph that you see, this is the moving average. If the volume is above the moving average, you see in this case, the volumes, the green candles that you see are above the moving average. That is the start of the journey. So if you can, in a good top 100 stocks of India, if you can watch the volumes and also understand the news factor as to what is happening, this is the time frame when the whole world was investing in Reliance. Facebook invested, Saudi government invested, there are a few private equity guys who invested. This was happening because these guys were buying in the market, and that is why the volume went up. So in top 100 stocks, you will never lose money if you know the entry and exit point. Yes, only if there is a some scam happens like Satyam, then that's a different story. So, but we need to be careful. So let us go to the next this thing. All right. So now, just 1 second. There's some pop-ups on my screen. Yep. So if are all the volumes the correct volumes, are there any false volumes also? Yes, there are some false volumes. How do I identify that? I'll just tell you. Just 1 second, very quickly. Yeah. So how are there any false volumes? Yes, certainly there are. Look at this one, this candle. I have mentioned 1 and 2 for you and 1 and 2 for you. The volume of candle 1 is greater than volume 2. Okay. However, the size of volume 2 is greater than 1. If the volume, if there are more people buying in the market, this point I'm talking about, in which case this one volume is greater than two volume, why is not the candle's size of volume of 1 greater than 2? In this case, what has happened is 2 is greater than 1. That's an alarming signal. More people are buying, still the candle is small. Less people are buying here. You can see this, less people are buying here because the volume candle has gone down. But I see a very large candle. So I will wait for a correct uh, candle to form and see what happened. In the next stage, you'll see that this has sort of come down. The third candle, like the small body that I'm talking about here, this one. I hope you can see this. There's a very small this thing body forms. So I will rely on candles which are in sync. This is not in sync. My volume is going down, okay, but my stock prices are going up. I will not choose that. I will choose for stocks, where the volumes, like for example, look this here, the volumes are going up, right? And my stock prices, the candle sizes are also going, just not the price, also the size of the candle. Size of the candle I can measure. There are tools to measure. I can visually measure it also. In this case, if you look at, again, I am telling you, the very important concern I'm telling you, look at the size of one volume candle, the second. This is in a decreasing trend. Okay, that you already know. Now I am looking at the size of the candle 1 versus the size of the candle. This is not in sync, so we will avoid these kind of candles. I hope this is making sense to you. This would make more sense when we are in the class. All right, so now again the question is, so this was one strategy, was a volume candle that we are talking about. That volume talks a lot about the price, but look for the right candles which are in sync and not which is in out of sync. The second one is, there are four strategies, and we will wrap up after that. So strategy 2 is an EM across. This you can easily find in investing.com. This is easily available. Look for a word called EMA. What is EMA? This is, so the E stands for exponential, the MA stands for moving average. So this is some sort of a moving average. In exponential, what happens is you give more weightage to the near time frame. So there are two lines that you're seeing here. One is a blue line, the other one is a red line. The blue line, uh, which is the darker line, which is one on the top, represents a moving average, exponential moving average, and the engineering students and MBA students would understand this, is a moving average of 9 days. And this is 26 days average, the red candle. The anytime there is a blue cross formation happening, you see there is a blue cross, I hope you can see that. And the green candle or the blue candle, however it is seen on the screen, meaning that 9 days candle is above the 26 days candle, you can enter into a stock. You also see whenever it is running up, you'll see that the green, this is ideally a green, the short one is a green thing, this is above the red one. But if you go to a downward trend, you will see that the green one is below the red one. So this gives you a signal, but this does not always tell you in advance. So it tells you later, little later, after the stock prices have already moved. So, but if you know that the EMA cross is moving upwards and the green thing is open, this is could be an entry point. So if I had entered markets here, Reliance Industries here, I would have gained here. But one technical chart does not help. So it is always the volume. See, the volume is also high. It is above the moving average. I see the EMA is also facing upwards, in which the green line, which is the 9 days line, 9 days average, is above the 26 days. Meaning what? I will explain this in Hindi because probably this will be easier, and we call it bhav. Price is called bhav in the stock markets. So 9 दिन का जो भाव है, जो पीछे के 9 दिन, जो रिसेंट 9 डेज है, 9 डेज बैक के जो भाव हैं, वो पुराने और 26 दिन के भाव से ज्यादा एग्रेसिव है, ज्यादा तेजी से भाग रहा है, इट इज मूविंग फास्टर. सो ये 9 दिन का जो प्राइस है, पिछले 9 डेज का जो एवरेज है, दैट इज above 26 days. So there is some action happening. So my old days भाव, मेरे पुराने दिन के 26 दिन के भाव जो है, एक महीने के भाव है, it is not reflecting of what is happening in the past 9 days. So this is some positive trend has come. So look at the volumes, which is a very high volume you are experiencing here, uh, right here, which is again above its average. This settings all come in the tools that is available free of cost, and the EMA cross is positive. So I hope you have understood this one. This is all available free of cost. You can always learn this with me. Will be very happy, and I will request college also to, maybe we can have a short classes on these ones. Let us look at another this thing tool that I want to give you is super trend plus stochastic. Again, this time frame is very small, so I can't tell you what is super trend, but these are all sort of moving averages which tell you, okay, whether my stock is going up or going down. So I am mixing two things, super trend and stochastic, and maybe we can hold a session on this one. Even if you don't understand, even if you are a man with a common sense, just figure out what the words are written on the screen, take a screenshot of it, and go to investing.com and just type in the indicators tool how to use stochastic. Just type stochastic and you'll see that this frame will automate. You don't have to know any maths, you don't have to learn anything, you don't have to go to professor. You just have to type stochastic in the indicators, and you'll see that this automatically appears on the screen. All right, and this is where I put my indicators. Then if you type super trend here in this indicator column, this is from investing.com, you will see that this has appeared. What has appeared? An indicator called super trend has appeared. Okay, so just one second. So you will see that a super trend has appeared here, and this line, the green line that you see, is a super trend. Very easy to do that, doesn't require any maths. Anyone can, even a 12th student can do this. I am challenging, if you have common sense, you can do this. So this was the chart that I pulled out, and this is for Glenmark Pharma. I have changed the this thing now. We were talking about Reliance, so this is Glenmark Pharma that you see. It is a one-day candle. Every candle here represents one day, which is what was the opening price at 9:15 and what was the closing price as 3:30. Green candle means 3:30 price was higher than 9:15 price. A red candle means that 9:15 price was higher than the 3:30, meaning what? 3:30 it closed at a lower. So if it is a red candle, the at 3:30 the market, the stock price is closer. So I'm looking at Glenmark Pharma. See what happened. I see that the stochastic is above 70. There is a level of 70 that you have to look at. This is also used by traders, and I can prove this, I can show this, that a lot of active traders are, this is not just pure theory. If your stochastic level, graph level, is above 70, okay, and if your prices are above super trend, you can get into a stock. This is somewhere around 8th of April that my stochastic was above 70. This is 70 is somewhere here, this level, and you can get into it and see how the stock prices have moved. But will you just buy and do nothing? No, there is an important concept called stop loss. So you would always, if the stock prices start declining, and if you are away from your computer, if you're not able to sell it, you have to use a concept called stop loss. Because that stop loss, if there is a sudden drastic reduction in the stock prices, if someone sells it heavily, you'll be saving your losses. So stop loss is always important. Please keep that in mind. And so I think we can move to the next slide. Just one second. Okay, so this is very interesting. And now I think we have the fourth, this thing. This is support and resistance level that I'm talking about. This is again very easy. Any simple man can do that. Any man with a common sense can do it. You don't require any difficult chart. If you are not able to use all the tools 1, 2, 3 that I've told you, just draw lines wherever you think the market's reversed. Okay. So this is again a Reliance chart. What I have done is I have drawn a line because this was the bottom point. From here the market is reversed, so I have drawn a line here. uh, this line also I have drawn, there was certain purpose of drawing this line, but let us ignore this support one right now. I have drawn this resistance because I see that every time my Reliance prices goes up and reverses from this point. Most of the time, see, it has reversed here, it has touched resistance 1 and come down, it has touched resistance 1 and come down, it has touched here, it has crossed. Okay, so I am trying to make a point now. Likewise, I am saying that yes. So let us again help you with this thing. So why support 2? I have drawn this line because it reverses from here. Here I have drawn for a certain reason because I was looking at this big candle. So you can ignore support 1 right now. Okay. So what happens when you look at this resistance and support level? These are the ranges in which Reliance has been operating for from October till June. That's a huge, and this always happens. All the big traders, all the big portfolio managers always use these support and resistance level. Now, the point that I'm trying to make is that if yeah, so the point that I'm trying to make here is if my stock prices cross the resistance, a 52-week resistance, if stock price, if it has crossed the resistance of 52-week, means what was the highest in the last 52 weeks? If it has crossed with a very high volume, what is the volume level? 49 million. That's not normal volume, that's a very very high, which is 4.9 crores, almost 5 crores of volume. And I also, so I can simply buy this stock and I'll see this, it is appreciating, it is correcting a little bit, but if I had bought it here at this point in time, you will see that the stock prices have started moving up. Again, I will reverse. If the stock prices are crossing a resistance, a major resistance, see, the stock prices always touches the line and comes down, so it's a major resistance. If it is crossing this major resistance, it could also be a 52-week high resistance if it crosses with a very high volume. Okay, ये प्राइस कभी टच ही नहीं किया स्टॉक प्राइस ने, इट हैज मूव्ड अवे फ्रॉम this old prices, it has made a new high in this zone, and that is why I call it as a 52-week high. What is a 52-week high? Basically a 1-year high. So if it is moving a major resistance with a very high volume, you'll see that the stock starts moving up and there are chances to make money, but you have to catch at the right time. Again, why we're talking? Are we talking from a short term? No. Are we talking as a fundamental analyst? Yes. Are we talking as a portfolio manager? Yes. Are we talking as a trader? Yes. You have to identify the correct entry point. Also, you would appreciate the fact, the stochastic that I spoke about, and MBA students would love this. It ranges between 92 and 72. It is still above 70. All these tools you can learn, if there is a guided thing, and this is available free of cost. There is this graph thing which is made here. If you just type stochastic, or if you just type support, resistance level, etc., you will get it here. There are other tools, also, there are other websites also. Okay, so I will now bring this to almost the close of the session, and let's see what's more in store for us. Initially, we had spoken about, I think this is almost at the end of the session, we spoken about call or put option. What is a call and put option? Call is when you are bullish, when you think that the stock prices will go up. It's a type of derivative. Why is it a derivative? Because the prices are not derived on it. It is based on the stock prices of Reliance. So that is why it is called derivative. When you are bullish on the stock market, then you will buy call. When you are bearish on the stock market, you will buy a put option. These are, though people say that there is, the losses are minimum, but you have to trade careful. That's my disclaimer, because most of the people lose money in call and put option, and that is because of an interesting concept. If you write down, as I said, I will give you some concepts which you don't know, or which are seemingly difficult, which you need to go and research. There's a concept called theta. You need to go and research on that. What is a theta? Because of the time decay. But the session is not appropriate because we have people from various segments attending this thing. Simple, you can buy and call and put option without knowing maths behind it. So if you're too bullish in the market, say this is what happened on around 23rd of March. This is around Feb. and the markets keep falling around 23rd of March. This is the lowest when it made when the lockdown was announced by our prime minister. So the markets keep crashing. Now, if you had seen this trend that it is going down, you also look at the stochastic is below, volumes have sort of reduced. The big guys sitting in Singapore, US, all the big traders knew that the market is going to crash. The economy news in December was not good. Still, the markets were running high. All these large retailer the traders were selling, whereas the retail traders were buying, still thinking that it would go up, and see what happens. And there comes the stock news. Uh, one second, someone has used the annotation. So there comes the news of COVID, and these news has only taken an opportunity to sell the market. So if you had bought a put option here, okay, you would have made a lot of money, because you make money when it goes down. Now, okay, we were not aware that COVID will come and we'll get stuck. Okay, so we missed that opportunity. Nothing. So as I said, you make money in both the scenarios. When the lockdown first unlocked, when lockdown was announced further, that will be extended, but you see that slowly the lockdown was relaxed, which is in the present form of unlock 1. Now, if you have seen that this is a made a bottom, we don't understand what is the real bottom, but you see the stock prices start moving up, then it starts coming down. We could have looked at a super trend, we could have looked at the support and resistance level, we could have looked at the very high volume. Now, generally when there is a high volume after such a market crash, market is likely expected to go up. So why not, if we have lost money same in the market, why not capture money? If you have lost the opportunity, why not use the opportunity to make money in this market? Because the market has already corrected hugely. We are seeing huge volumes. We know that this is almost, it felt in March 23rd that it was the end of the world, but slowly the economy has been opening. So all these stocks and the manufacturing factories will come back to its normal, and this is what you see. So when you were very sure that the markets would go up, then only you should buy a call option. There is an inherent problem with call option, which is that it loses value every day, small value every day. So you should not be buying a call option until unless you are too sure that the market is very bullish. I could have bought a 1 month, 2 month call option and made a lot of money. So derivatives gives us this thing. Even if you don't know derivatives, I have given you a lot of information on the stock markets as to how you can make money from the stock options. Call and put option with people who want to take risk. They say it's minimum risk, but the premium you can lose. So for novice, I don't recommend, but you should definitely know. If you don't know, you are not contributing to the nation. You're not knowing the product. You're not knowing your financial market. And like fighters, our army is fighting at the front. We have to make our financial markets also strong by learning about it, by investing, even buying one stock in a month, in a day, in a year, and converting your knowledge into execution. There are some inverted sort of chart patterns also. So all these stock patterns that you looked at, they say something. You have to read it. There are some tried and tested chart patterns. One of the very famous is inverted head and shoulders. So the last point on my slide. So if you have learned how to get into and get out of it, the easiest way is to, if by looking at these, even if you don't have time to do all this analysis, I can go to a stock and look at for identify these kind of chart patterns. This is an inverted head and shoulder. Why this is an inverted head and shoulder? Because you see that this is the head, this is the shoulder one, this is the shoulder one. Once it looks like an inverted head and shoulder. This is the whole body, right? So if this looks like an inverted head and shoulder, and if it has crossed the shoulder, you see that the stock prices. So there are chart patterns that are important to notice. So again, I will sum up my presentation now, and we have come to the end of it. I will open it for the students to ask questions. What are we trying to say? Okay, so let us come to the presentation where we started. The point that we are trying to make is there are two ways to get into stocks. One is the fundamental analysis, which you have to know for sure. Technical analysis, most of us are not taught. We think it is only a speculator's things. That is not correct, because they tell you the entry and exit points. They tell you that this is the point that you can enter. Just knowing the fundamental analysis will not help you, because like good people and bad people, there are also speculators in the market who are driving the prices for no reason, and real small people, retail people, honest people get stuck. So you have to learn technique. Is it hard? No, it's very easy. If I can talk about it in 1 hour's time, you can definitely learn in about a month's time. So this is all from my side. I will stop this session, and I will open this up for any questions from the students, and then the closing note from our dear professors. Thank you from my side.
Thank you, sir. Sir, we have too many questions, so I'll
Okay.
read few of them.
Yes, certainly.
uh,
What is the time right now? I don't have an access to time right now because.
12:20 it is.
Okay.
We'll take few good ones.
Okay.
Um, Aarti Nachankar is asking you, which analysis is more useful to minimize the risk, fundamental or technical?
Aarti, as I said, both are important. So far, unfortunately, I would say, because though we have projects based on technical, and every MBA college gives this. Even in MS Finance, we were given a technical analysis, and my technical analysis ran into 100 pages. But we are never told to use it. The most important point is fundamental analysis, because without that you are not knowing which, if you are in India, if you are investing only in India, which sector to invest in, which is point number 2, which is which industry to invest in and which company to invest in. So it doesn't come without that. Once you have finalized, okay, that there are 4 5 stocks, like, so for example, Arvindo Pharma, Glenmark Pharma, Sun Pharma, Cipla, then which company should I choose? So then I will go and look at their profit analysis. So there's a future outlook, profit analysis, etc., which is point number 4. Once I have figured out, for example, this is just for educational purpose, I am not asking you to buy any stock through this medium. For example, if you have figured out that, okay, Arvindo Pharma is the stock that still you think can, go from 800 levels, 790 levels, it can still go to 1000 levels. But whether to buy at 790 or 800 or 750, whether it will come down, come up, who will tell you? Because if you buy at the right price, you make money. If you buy at the wrong price, you lose money. And that only technical analysis can tell you. आप मार्केट में जाते हो, भाव जाते हो, 2 4 दुकान कंपेयर करते हो ना, likewise you have to look at the graphs and charts, and you have to figure out which stock to buy. Yes, ma'am.
Sir, next question is from Rodkar sir. He's asking, even the PE, if the PE and results both are good, still price may move down. What is the reason why it goes
Yes,
down?
if the price and if the P ratio is good and attractive, uh, one is whether it is high or whether it is low. So I am assuming that you're seeing that the price to earning ratio is high because the prices have moved up, and the news is good. The stock prices some down move uh, because of 2 reasons. One, because of speculators in the market. There are, as I said, there are a lot of good people. There are a lot of bad people also. So there are a lot of bad people. Also, if the news is not in expectation of what it should have been, I say that I have declared a result of 1 rupee, but the market was expecting a result of 2 rupees. That is one point. Second, all these news are analyzed very well. One quick example, the Glenmark prices ran up from 4 15 16 rupees levels to almost 580 bucks one day. Next day starts coming down and comes to 475 rupees level. Why? Because these analysts who are sitting there, they realize that Glenmark Pharma, which has said that which will be releasing, we have got the license from a stock from a pharma company and will be releasing in the Indian market. The business was only of 50 crores. So it ran on the speculation, but you will see that it also came down, right? So they thought in the Glenmark company is a huge company, and 50 crores business is too small a business to be added to their kitty, and hence the stock prices will come down. So third thing, maybe the stock prices have already run up, because as I said, the stock prices are an expectation of future. So the traders are smart. There are insiders who know that the news may be released. So they have already bought these stocks. It has already run up and then start declining after the retail investors get into. So you have to look at the chart pattern. You have to see what was the previous trend. As I said, if the stock has been already running up for quite a few days, you will skip that. So that is why the chart pattern is important. Yes.
So the next question is from Muskan Gupta. She's asking, is arbitraging helpful to minimize the risk of volatility in the market for the investor?
Yes, arbitrage is certainly helpful. Who would do get into? There are arbitrage products from Kotak also, if I understand. I have not personally bought any arbitrage product. Neither I do, so I don't have expertise. But arbitrage from hedging perspective, certainly yes. For example, if you run Indigo Airlines, if you are the CFO, Chief Financial Officer of Indigo Airlines, and what is your daily activity? Your daily activity is buying oil for the airlines, and sometimes you realize the oil prices in the market is 30 barrels, $30 a barrel. Sometimes it is $50 a barrel. Sometimes it is $70, and sometimes $100 a barrel. So if you have not sort of hedged your risk, because sometimes you're buying at $30 a barrel, next day you're buying at 100 because this oil prices are volatile. So you need to hedge your risk. Arbitrage certainly helps you in arbitrage is one way to sort of make money. Hedging certainly helps in this case. Arbitrage is buying in one market and selling in the other market. If you are a trader, you can do that, but if you are a chief financial officer of any large airline company, you would not do that. So you will look at call option to hedge your risk. um, there are arbitrage products that you can explore.
So the next question is from Shiv Chawla. He's asking, what are the sources for all technical data? Are they available on NSE site, or is there any kind other source available?
Yes. So the first site that you should access daily is National Stock Exchange. There are a lot of mm, there are a lot of platform. Just one second. Give me 1 second. Yeah. There's some issue with the charge. Yes. So National Stock Exchange is the one site that you should fall in love with. There is a lot of data available there. You should analyze, and you should never look at a standalone data. You should always look at averages for 3 days, 5 days, 8 days, and so you compare. Sites like investing.com, tradingview.com, and probably when I come to your college, I would also request the management if they can launch a similar workshop or a class. It will be helpful. So these are all free websites. You don't need to pay any money. Anyone asking money from you, don't pay. For broking, opening a demat account, yes, you would have to pay. But trading.com and tradingview.com, investing.com and tradingview.com. Let me repeat: investing.com and tradingview.com are very, very powerful websites. And you can also do paper trading. You can do virtual trading. I run my own programs where we teach students to do virtual trading. So hopefully someday we will do that school also. You are at MBA school. Yes.
So the next question is, P ratio depends on what? The face value or the market value?
It
When
depends
we
on the.
sh- huh.
Yeah. Sorry. Please go ahead.
When we should go for short or long selling? And his third question is NSE forecasting the company's profit on the history of PE ratio?
I will reverse order this in reverse because the last question was more important. Whether NSE forecast, NSE doesn't do that. It only gives you historical data. Historical data does not capture future. That you have to do as an analyst. The first question was, price to earnings, related to price to earnings ratio. It is based on the current market price of the stock. So it is changing every moment to moment because the price is changing. It is not the market. It is not the book value of the price derived from the book value. That is not correct. It is the price reflects the stock market price. When you should buy or short, well, you'll have to use all these strategies. Don't start shorting just on the basis of P analysis. First, to identify which stock you would rather buy and why would you buy it. Write it down. Do paper trading. So just write it down that I bought this shares at say 100 rupees at this price, and then check the prices tomorrow and figure out the reasoning. So look at good stocks, 100 stocks that we talk about, and start learning charting analysis as to what should be you do with each stock. It tells you a lot of stuff, and there are 4 strategies that I gave you that you can always refer to.
So the next question goes like this: derivatives helpful to minimize the volatility of the market, or to minimize or maximize the volatility of the market?
Well, derivatives has various purposes. It helps speculators. It also helps in minimizing the risk. Now, speculators do what? They increase the volatility and the buy, and they, pump extra money. They take it high, and then immediately they get out of it. So this increases the volatility. Derivatives has a good function also in the commodities market. It helps in price discovery for traders and large traders. Maybe farmers are not accessing. That is the idea of the government, that farmers also access the commodities exchange to see at what price they can sell. So it helps in it serves both purpose. Warren Buffett says that this is a weapon of mass destruction. So Warren Buffett asks you to stay away from derivatives. But can you really stay away from derivatives? I don't think so. As a student of finance and a practitioner of finance, you have to learn how to make money in this one. And no instrument is good or bad. if you have a disciplined approach, and if you're taking a calculated risk. If you know the risk, if I for say Monday the market will open at 9:15, if I'm planning to buy a call option on say Reliance, for example, and I know that the maximum I can lose on Monday is 50,000 because I'm buying this product. So I know my risk, and that is a calculated risk. So you have to know, and you have to minimize your risk. Yes.
Sir, the next question is what from Akash saying, what tools should we use for intraday trading?
What tools you should use for intraday trading? Look at, maybe you can write it down. You can look at which are the top gainers and losers. You should look at where is that what is the volatility of these stocks. It should be greater than 2.23. Also look at what is there's something called volume weighted average price. What is the stock price above the weighted average price, the average price of the other previous days? It is available on NAC. Look at what the EMA cross tells you, which is exponential moving average. All this is saying is basically, in short, is my today's price, that the price that I'm stock that I'm going to buy, is my price going to be above the historical averages? It could be a 1 day, 3 day, 2 day, 5 day, and this is what all your charts and all your charting technologies are telling you. Also look out for very high volumes in stocks, good stocks, top 100 stocks. Look for high volume, and if it is breaking its previous levels, maybe 3-month old level, it is breaking. If it is breaking its 6 months old level, if it is going above the 1-year old prices with a huge volume and a huge candle, that's an entry point. But again, as I said, this is a disclaimer. This is only for educational purpose. You will have to learn this on your own, or maybe get trained under someone expert. Yes.
So the next question is what are the resources available for beginners to start analysis and implement its application by investing in the markets?
Okay, the biggest tool that you have on the planet is YouTube. There are a lot of educational videos available. Investing.com, certainly. Tradingview.com, certainly. These are the two websites where you can plot your charts, the charts that you saw. YouTube has a lot of information. If you have anything, you can always write to me. Calling would be difficult because I may not be able to answer. You have to find a mentor or a teacher or an expert trader who can tell you. Don't be too greedy in the market. And if you use these tools, investing.com, tradingview.com, a lot of videos on YouTube, you can always come back to me with questions and experience this one. But do not forget your stop loss. You have to know how much you should be losing in a day. Don't keep sitting on your portfolio if you lost huge amount. You have to cut down your losses at some point in time. Yes, ma'am.
The questions are over flooded, but due to the time constraint,
Yes.
we need to have a hold on it. So
Yes.
I
Yes.
invite Swati Gupta, madam, for the vote of thanks.
Thank you very much, ma'am. Thanks.
Am I audible to everyone?
Yes, ma'am, you are.
Okay. Thank you so much, sir, for your valuable insight on the topic. We take great pride in being associated with you. And thank you for all your suggestions, information, and guidance on the topic of volatility of stock market. Thank you so much. With this, I want to express my gratitude towards our Honorable President, Sri Jagdishji Gupta, and the management body to their valuable support and motivation and inspiration to hold this webinar. I also extend my thanks to respected Principal Dr. S.M. Kherde sir for his valuable guidance and support. With this, I also want to thank Dr. P.R. Madasne sir, Dean Student Affairs, and Professor Sergey Rao Patil and Professor Pardhi sir for their support and resources. I'm also thankful to our HOD, Dr. M.D. Jadhav sir, and all the staff members for their continuous support. And lastly, we are thankful to all the participants who have taken their time and actively took part in the session for the common society benefit. And I request to stay connected with the Department of Business Administration, the MBA department of Sipna College of Engineering and Technology for such kind of technical events in future. With this, I declare that the webinar is completed. Stay safe, stay home. Thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Bharati
Thank
sir,
you.
look forward to for your valuable visit to our campus.
Definitely, sir.
Yeah, you are
Definitely,
most
sir.
welcome, sir.
Thank you, sir.
Thank you very much, sir. Thank you.
Thank you
Thank
to
you so much,
President,
sir.
sir, to
Thank you, sir.
Principal, sir, to the entire management committee, to Sarjirao Patil, sir, to entire staff. It's been a very helpful and supportive environment that I was given since yesterday to be a host on this, to be a guest on this platform. So thank you for hosting me here. Thank you very much, and have a good day. Stay safe. Thank you.
Thank you so much.
Thank you, sir.
Thank
Good day.
Thank you all.
Chawda madam.
Madam, please drop a message on the chat
Ha, ha.
box of YouTube. I'll drop a message here also on the Zoom meeting. After 5-10 minutes, I'll conclude the meeting from here.
Okay, ma'am.
Okay.